My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. If companies would just own up to their changing circumstances, things would be so much easier for everybody. But who wants to admit that they made mistakes? If they just own up, I think they'd earn a lot of credibility for themselves, leading to higher stock prices down the line. Instead, their stocks languish as investors try to assess what's really going on, and they presume the worst, not the best. And that's what I've been thinking about on a day like today, where the Dow lost 141 points, S&P was basically unchanged, and Nasdaq advanced 0.21%, because there's so much information and misinformation flying around at this point in the earnings season that it's very easy to be led astray. So let me give you the most egregious examples of omission that I've seen this earnings season that will cause you to make faulty decisions. Notice, I didn't say anybody's lying, but they're leaving out important information that can cause you to make mistakes. And it's you that I care about, not them. First, despite the fact that roughly 20 million Americans are said to be taking the GLP-1 weight loss and diabetes drugs, no food or beverage companies willing to admit that these drugs have hurt them at all. They won't even hint at it. Now, let's puzzle over this. We know that people eat much less when they take these GLP-1s. We know that they consume a lot less snack food, for instance, because the drug tamps down on cravings. Do you wake up in the morning and drink alcohol? No, of course not. But after work, it tastes pretty darn good for many Americans. Natural, right? But that's not likely in GLP-1s because when it comes to liquor, it always feels like it's 7 in the morning. There's no real taste to alcohol, so why drink it knowing that it's not good for you? Wine? You prefer grape juice. Again, no cravings. These drugs are incredibly powerful. The idea that they aren't doing any damage to the snack food companies or the liquor places is just insane. Yet, here's Mars apparently on the verge of buying snack food maker Kellanova. Here's Smucker's thrilled with its acquisition of Hostess Brands with its flagship Twinkies. Here's Brown-Forman with horrendous sales. It's, I don't know if you know any, like Tennessee, because I've got to tell you, their stuff. When you drink Jack Daniels, it is filled with sugar, okay? And that is really being impacted, but they won't say what it is that's hurting them. They say it's not cannabis, they say it's not GLP-1s. But same thing with Diageo, the liquor company. Why is Casamigos down 20%? No one will say anything. I've got to tell you that the refusal to attribute any of this weakness to GLP-1s is just hogwash, okay? Hogwash. If you didn't know better, you might think that these companies all got in a room and said, do not mention GLP-1s, no matter what. No matter what analyst says it, no matter what reporter asks it, do not let it be known. I wonder how long they can maintain this fiction. It would be better if they just own that it's a problem rather than ignoring it. The price earnings multiples are shrinking as it is. I mean, is anyone fooled? Who knows how much they're really being hurt unless somehow we've decided that 20 million people eating about half of what they used to and drinking dramatically less doesn't matter to these companies? And the GLP-1 users tend to be gigantic consumers of the worst. That's what they do. So you've got the biggest consumers eating much less. Come on. It drives me crazy. Second canard. Nobody has to lower prices. Everything's fine. Very few companies have reduced prices post-COVID, no matter how much they raised them during the pandemic. Costco and Walmart have pushed prices back. No coincidence that they've been among the best-performing retailers. But the airlines, endless underperformers, simply wander up to any need to roll back prices. They act as if they didn't even take them up in the first place. Hotels and entertainment are no different. They raised prices drastically during COVID. They won't cop to raising prices too much, even as their forecasts are coming down hard. Many of the restaurants have asserted that their price increases haven't really hurt sales, or in some cases refuse to admit that they need to roll them back. Starbucks, for example, gives good deals to its rewards members, but they can't seem to get new people to join. I think that's because there's no entry-level coffee offering with a low price to get people in the door. They don't want to go there. Is everyone in the industry obtuse and in denial? No. Just like Costco and Walmart, Chipotle, arguably the best-run restaurant chain, admitted to raising prices too high in California because of the impact on their bottom line from the state minimum wage. It hurt sales, and they acknowledged it. Hey, is there any reason why Chipotle's the best, acknowledged best-run restaurant chain with the best stock? They own what's wrong, and they change it. Third canard, we're constantly being told that none of the big companies spending a fortune on NVIDIA chips for AI has seen any meaningful return on that investment. They're only doing it to prevent their competitors from getting an edge. That's what we keep hearing. That's absurd. Memo to the clueless naysaying individuals. Have you seen what Meta Platforms has been doing with their computing power? They have, out of nowhere, become one of the most popular generative AI platforms with Meta AI. You have to try it. I have switched to it. It is that good. Meta's been using their NVIDIA purchase to make Instagram and Reels much more relevant to you, much faster, cleaner. Meta has the best numbers of any of the tech titans. You think that's some sort of coincidence? Google and Amazon aren't buying because they're worried that the other guys might do something. They're specifically worried that Meta's going to catch and pass them, and they should be. NVIDIA's Jensen Huang has been touting you can get 4 times your money if you buy his chips. 4 times return. I think Meta could end up getting that. The others, they actually have to spend to play catch-up. It's not mythical, it's reality. How much money have you made over the years betting against Jensen Huang? Fourth card, and it is a good one, that has fooled many a people, many a people. Intel's fine, better than ever. Don't worry about it. I keep hearing that Intel's going to make a huge comeback, that it's catching up to the others in the data center, that has an NVIDIA killer in Gaudi 3, that it's using the CHIPS Act money to further its dominance. Dream on! Have you seen Intel's balance sheet? Can you read one? Do you think a company cuts its dividend last year and then suspends what was left of it this year in order to assert its dominance? Look, this is not the Intel of old, even though we want it to be. When it was the Colossus that bestrode the universe. AMD isn't nipping at their heels. AMD is dominating. It's actually taking gobs of market share. And Gaudi 3 is not a factor when it comes to NVIDIA's high-end chips, despite Intel's protestations. I wouldn't want to be Intel's partner. Not that, again, anyone would ever admit to that, whether they're in government or whether they're in business, whether they're clients, whether they're customers. Fifth and final, we're told enterprise software is doing better than ever. Forget that this is the single worst area of the stock market. It's a wasteland, people, as companies cut back on their spending on software that's meant to help them run their businesses better. Perhaps they can't figure out the return on investment in a world where AI could make all sorts of employees redundant. With the exception of ServiceNow, and by the way, no need to tell me that I'm doing it right, ServiceNow. Except of ServiceNow, so many of these enterprise software companies reported so-so or just plain bad numbers. We don't know why, but it would help if anyone in the segment would own up to what's ailing them. They won't because they're so used to delivering blowout numbers. They keep hoping it's going to come back. They don't know how to explain away the disappointment because they refuse to even acknowledge it. Bottom line, that is a short list because I don't have all day of obfuscations, canards, and downright refusals to recognize the problems and hurdles businesses are facing. Maybe they think if they ignore the problems, they'll go away. Let me ask you, has that ever worked for you? Denial is a powerful defense mechanism, but it is a terrible way to run a business. And by the way, Kesha was quite wrong when she said brush your teeth with a bottle of Jack. There is no time that is a good idea. All right, let's go to Steve in Arizona. Steve.
Hey, Jim, how you doing?
I am doing well, Steve. How about you?
Good. Just signed up a club member last month.
Yes!
Yeah, definitely, man. I consider myself a mid-level investor. I'll make it quick. There's just 2 things. I just wish some of your callers wouldn't bother spending so much time going over a stock chart endorsing a particular stock. I'm sure that wastes everybody's time. I'm sure you'll agree with that.
Everybody's nice who calls. I'm thrilled. And everyone's very graceful and gracious, and so am I. So go ahead, Steve. Go ahead.
Yeah, Taiwan Semi, out here in Arizona, $40 billion plant. These guys are just, I know it's the whole geopolitical thing, but, it's wow. These guys are.
I think you're fine. I do think that there is always going to be a worry about Taiwan. I think that, though, if you go back to what Lisa Su, the great Lisa Su, said from AMD, she didn't tell you not to worry about it because nobody says that. But she says, look, this one is not going to be a problem, and I am with her. Let's go to Sharon in Minnesota. Sharon.
Hey, Jim. Thanks for all your help. I just wanted to ask about ELF. It's gone down in price, but with the lower guidance, do you think now is a good price, or would you hold
you know
or
what?
sell?
I don't usually say this, Sharon, but it's disconcerting to me that Ulta hit a low. The action in Estee Lauder is so horrible that they ought to just issue a release saying we don't know what we're doing and we're going to just go away. So I'm worried about ELF just because the competitors are flailing so badly. I will give Tarang his due, though. He'll come out of it first. But this is the single worst neighborhood I have ever seen.
The House of Pain.
In this market. Let's go to Jack in California. Jack.
Booyah, Jim. Fight on from Southern Cal.
Love it.
I was curious as to what you think for the future of Paramount Global, considering the merger with Skydance Media.
I think this is a fabulous time to sell it. It's a fabulous time to sell it because you're still going to get $10. They can't take that away from you. Kind of like, who's that, Gershwin? Anyway, that's the deal. Look, maybe all these companies want to believe that if they ignore the problems like pricing and GOP-1s, they'll go away. I say that's hardly ever worked. Oh, man, tonight, steelmaker Cleveland-Cliffs hit a new 52-week low today. Red flag or buying opportunity? I'm hearing from the CEO. Then I'm taking a look at one sector that I think will benefit the Fed's environment for the rest of the year. You won't want to miss it. And not many companies can say they make ice cream machines, outdoor fans, and hair dryers all under one roof. I'm getting a read on the consumer with the CEO of Shark Ninja. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
We're in a tricky moment for the cyclical stocks. On the one hand, these are economically sensitive stocks and perform worse than when the economy's slowing. Yeah, and it's definitely slowing. On the other hand, though, they're going to get a huge boost along with the broader economy when the Federal Reserve eventually starts cutting interest rates. And I think that's coming. When you look at the materials companies, though, right now they're trading like a recession is inevitable. And the Fed's too clueless to do anything about it, even though that's completely wrong. Take Cleveland-Cliffs, a major American steel producer with a focus on value-added sheet products, especially for the auto industry. Here's a stock that's down 45% from its highs in April. Just when it looked like it was stabilizing last month after a solid quarter, people started freaking out about the economy. And Cleveland-Cliffs became a house of pain, even though it delivered great numbers. It set a new 52-week low today. But, man, the moment that the Fed starts cutting rates, people will be kicking themselves for not owning the steels, including maybe especially this one. So do not take it from me. Let's check in with Lorenzo Gonzalez. Now, Lorenzo is the chairman, president, and CEO of Cleveland-Cliffs to get a better sense of what's happening here. Mr. Gonzalez, welcome back to Mad Money.
Thank you, Jim. Always a pleasure speaking with you.
Okay, so let's go over this. I know as a former hedge fund manager that the stock you want to own when a Fed rate cut is coming is the coiled spring kind of stock. And that would be a company that reported great numbers, but people don't like it because of the cycle. That would be you. Could you please explain to people the way the market and the steel market work and how important this is to be able to try to start buying the stock?
Thanks for the opportunity, Jim. That's the right question at the right moment. Cleveland-Cliffs is a cyclical stock in a cyclical market, and cyclicality is a friend, not an enemy. At this point, we can only go one way, and the way is up. The economy continues to be in decent shape. Of course, the Fed will have to start acting on interest rates. All the things that were indicators that would allow them to be paralyzed are moving now. So it's about time for things to start to move in the other direction. Our business continues to perform. We are taking actions on our side to do our part. So there's only one way to go, and the way to go is up.
Well, now I searched the entire panoply of what can go on in the steel business to try to figure out why the prices keep falling. I come back to maybe a lot of people are using Mexico to bring in steel like they shouldn't because that's just patently illegal.
Well, prices at this point kind of stabilized at a low level, but they stabilized. Prices are no longer going down. As far as Mexico is a big problem. Mexico is not a friend. Mexico is a dumping ground for transshipment. Mexico will be taken care of in the next revision of the USMCA in July of 2026. We can no longer afford this situation with Mexico taking advantage of our free trade agreement with the United States and Canada. Both countries are being damaged by Mexico, and this is about time to stop.
I'm glad you mentioned Canada because I think that Stelco is a really excellent company. And if you get that deal done, it will just make it so your company is, I think, even a little less cyclicality, but tremendous value. But is there a chance that any one of these regulatory agencies can get in the way? I know Canada's in favor of it. I know the workers are in favor of it. But I don't trust our governments to be able to favor of anything.
Well, deals are approved because the deals make sense and the deals do not cross any lines or do not inflict any damage to important constituencies as the union. In our case, we have union support. We have support from the province of Ontario and from the federal government in Canada. We are doing a good thing for the country of Canada, and we are not buying anything that would conflict with the business that we have in the United States. Actually, Stelco is a big player in a portion of the market that Cleveland-Cliffs is not strong. We are strong in high value-added, high-end automotive, stainless, electrical steels. Stelco is in the commodity side of the business. So it fills a void in our portfolio, and we will not have any problems in clearing antitrust or anything like that.
Excellent.
So it will be a smooth closing. We're going to be done by way before the end of the year.
Okay, well, let's talk about another deal that I think you're not a big fan of, Nippon Steel. Buying Letter X, U.S. Steel, which initially you wanted to buy. You reference it, actually. You talk about it in your most recent conference call. You talked about Mike Pompeo, who's got an interesting piece in the Journal not that long ago, and that he may be damaged goods. He's obviously at the forefront of trying to get this deal done. Do you think we'll have success when current President Biden and potential President Trump are saying this one's dead in the water?
Look, there are very few things that can unite both sides. The opposition to that Nippon Steel deal is one of the very few. Neither the Harris side nor the Trump side would support anything related to the Nippon Steel deal. That said, Mike Pompeo, being a paid supporter of the deal, just signed off not to be part of any possible Trump cabinet going forward. So, like I said in the conference call, damaged goods. Mike Pompeo and hundreds of other paid opinionators that were hired by either U.S. Steel or Nippon Steel is not advancing the ball, and the fate of the deal is being decided. Good luck to both U.S. Steel and Nippon Steel. I'm focused on Stelco right now. That's the important deal for us.
Understood, but you have done 2 deals in 1 year, so you actually are capable of doing many deals if you'd like to do. If you think that they're valuable to shareholders, I know you will do them. But I would think that buying your own stock down here versus buying another company after Stelco might be a better investment, that maybe your stock's a better buy than owning U.S. Steel.
At this point, we are the most undervalued among all. And we are the ones that are focused on the high end. We are filling the gap by acquiring Stelco and playing a bigger role in the commodity side of the business. So we're very comfortable where we are at. We will continue to build the business. We are going downstream with the production of transformers. We are doing what we do best. We are doing what we have to do in order to continue to generate real value for the shareholders. Unfortunately, in a cyclical business, that doesn't happen every day, and eventually that doesn't happen every quarter. But in the long run, that's where the value is. We will continue to work that way.
Yep, and I'm sorry that we did not get to talk about Weirton and the Transformers, because that's a fantastic business that you're going into. And I feel badly. I would have liked to talk more about trade policy, because I think that what you said about Mexico, unfortunately, is true. They have a new president there. I was kind of hoping things would change. Hasn't changed yet. Anyway, that's Lorenzo Gonzalez. He's the chairman, president, and CEO of Cleveland Cliffs. Guys, if you want the coiled spring, you just heard it. That's this one. Lorenzo, thanks for coming on the show.
Thanks, Jim. Always a pleasure being with you.
Thank you. Mad Money's back after the break.
Coming up, not feeling at home with a pure play housing stock? Cramer shares a few alternatives. Next.
Call me a wide-eyed optimist, but I think we're actually in pretty good shape right now. Sure, there are signs of economic deterioration all over the place, and it probably would have been helpful if the Fed had cut rates at that last meeting. But if you're tearing your hair out because we'll likely get a rate cut in September rather than July, I think you're missing the big forest through the trees. Even though the economy has slowed, we've still got solid growth. 2.8% GDP growth in the second quarter, and the Atlanta Fed estimates it'll be 2.9% in the current quarter. The unemployment rate has ticked up, but it's still at 4.3%. I used to celebrate that level until 7 or 8 years ago. Every economist in America, if not the world, would have told you that we're basically at full employment with that number. Corporate earnings look, of the S&P 500, we've already heard from 455 of these companies, and on average, earnings are up more than 9% year over year. Best of all, because inflation now looks to be fully defeated and the economy's cooled down, the Federal Reserve can start doing its interest rate cuts in September, giving the economy a boost. We're actually in no man's land, but it's no man's land going to something good. With the prospect of rate cuts on the horizon, it's time to start betting on the return of housing, as well as the repair and remodel market. By the way, that's been what's really weighed down on this group, and that's heavily fueled by home equity loans and thus very much hostage to interest rates. And that's why I told you about Weyerhaeuser, the largest owner of timberland in America back on July 10th. It's rallied almost 10% since then, even as the S&P's down 5% over the same period. But if rates are coming down, then there are many other ways to play the housing and this R&R thesis. Prepare, remodel. Let me walk you through these because they're really interesting, and we've had a lot of them on. Let's start with Builders First Source. That's the nation's largest supplier of building products, value-added components, services to professional builders. That's who they really serve, okay, not you, both for new construction and remodeling. These guys have distribution centers all over America, and they're consolidating what's historically been a very fragmented industry. Home builders and contractors have professed love for this company. Plus, during the terrific run for home builders over the past few years, Builders First Source saw its stock rise from $9 in March of 2020, okay, COVID crash lows, to just below $215 at its peak in March of this year. Since then, it's pulled back nearly 29% from its highs, but that's kind of where these stocks have gone. It's in the 150s, where the stock looks pretty darn good to me, selling for less than 14 times this year's earnings estimates. Look, speaking of earnings, last Tuesday morning, Builders First Source reported an interesting quarter. While the company essentially matched Wall Street's revenue estimates, they blew away the estimates on the earnings front, making $3.50 per share. Analysts were only looking for $3.02. However, management also took this opportunity to cut its full-year sales guidance by $1.2 billion at the midpoint of the range, while trimming its earnings before interest, tax, depreciation, and amortization guidance by $300 million. That is brutal. While that guidance cut looks bad, management didn't seem the least bit downbeat, though. In fact, Builders First Source actually announced that it had repurchased nearly $1 billion worth of stock in the quarter and told us the board to authorize another $1 billion buyback. I mean, keep in mind, this company's it's significant. This company's only an $18 billion company, for heaven's sake. At the end of the day, I think this was an appropriate reset of expectations for the year, but also a demonstration that Builders First Source can still perform well in a tough environment, and a huge vote of confidence in the future. If I were them, knowing that rate cuts are likely in the cards, I'd be authorizing huge buybacks too. And that's why the stock rallied 4% in response to that what looked like a terrible forecast. You know what? I'd still be a buyer because I bet Builders First Source has a lot more room to run. Don't buy it all at once. It's a wild trader. And that's why I also like Ferguson. That's a leading distributor of building products, especially for plumbing and heating, ventilation, and air conditioning systems. Ferguson is very similar to Builders First Source, but the main difference is that they serve both the residential and non-residential construction markets. Fine by me. Though as both residential and non-residential benefit from lower interest rates, this stock's had a nice move since the company moved its primary listing from London to the New York Stock Exchange in the spring of 22. Ferguson climbed from just below $100 at its lows in October 22 to a high of $225 and change at the end of July. But the stock's been knocked down 30 points, or more than 13% from that high in less than 2 weeks, without any company-wide specific numbers. No developments. I think you're getting a nice chance to buy a quality stock at a discount before Wall Street goes crazy for Ferguson again once the Fed starts cutting rates. Who else? Yeah, there's a reason we own Stanley Black & Decker for the Travel Trust. This toolmaker saw its stock drift lower in the first half of the year, largely because of a slowdown in home building, repair, and remodeling. But then Stanley Black & Decker caught fire after the cool June CPI reading, then jumped higher still after the company reported a strong quarter at the end of July. If these guys can deliver a small revenue beat and a 25-cent earnings basis off an 84-cent basis when times are tough, imagine how much they can make when the Fed starts cutting rates. In response, the stock jumped 10% in a single session. But that was right before the market started rolling over. Since then, the stocks erased all of its gains and then some. You're now getting that excellent quarter for free, including a raised full-year earnings forecast. If you believe that lower rates are coming, then Stanley Black & Decker is another really great opportunity. Now, I will be discussing Stanley Black & Decker at our CNBC Investing Club meeting Wednesday noon, so be sure to join us. Remember, we sold some higher, trying to figure out whether to buy it back. I'm going to talk about that. Now, there's one name that could potentially fit this theme, but I'm holding off on it, recommending right now, and that's Home Depot. Home Depot, which I'm hesitant to recommend because it reports tomorrow morning. I think there's a good chance that despite has soft numbers for the reported quarter, the 3-month period that ended with July. That said, the report could still be a very positive catalyst if management paints at all a positive enough picture of its outlook in the back half of the year as rates start heading higher. Either way, I'm not going to stick my neck out. I mean, let's just wait 12 hours, see what they say. Bottom line, if you like me, think we're not headed for a recession, taking it off the table, the Fed will soon start cutting rates from a position of strength. Then you should be looking for groups that benefit from lower rates and a relatively solid economy. Groups like the home building, repair, and remodeling plays like Weyerhaeuser, Builders First Source, Ferguson, club names Stanley Black & Decker, and potentially after tomorrow, Home Depot, depending on what they have to say when it reports at around 6 a.m. How about Matt in Pennsylvania, please? Matt.
Hey, Jim, how we doing? Go Birds.
Go Birds. Yeah. Oh, we're heading to New England right now. What's up?
Absolutely. All right, my question is, Jim, thank you for taking my call. I've recently built a retirement portfolio of dividend stocks that include Procter & Gamble and Colgate, and recently I picked up shares of Realty Income. It pays a monthly dividend with a steady increase in price per share. What insider advice could you give me about this type of position?
I actually really like Realty Income. I know that there's some concern that some of the companies that are inhabitants, the ones that they use, like the drugstore companies, could be in trouble. But I think you're absolutely right. The monthly dividend is terrific, and the stock has been a rocket ship, and I think it's going to stay strong. It yields 5.23%. Pretty good. And thank you for the call. If you're an optimist like I am and think the Fed will cut rates before we get into recession territory, I think you want to look at the home building and remodeling plays. That's a group that will benefit from lower rates and a solid economy. I just gave you some good names. Much more Mad Money, including my solution with Shark Ninja SN. As the consumer faces inflationary prices, could a company like Shark Ninja pull ahead with its mantra of high-quality, low-cost items? I'm finding out more with the CEO, and they have a lot of cool stuff in the stores. Then we're all still trying to understand the implications of last week's major 1,000-point drop in the Dow, but I bet the explanation is simpler than most people think. I'm going to share my thesis after being on the street for more than 40 years. And all your calls, of course, rapid fire tonight's edition of the Lightning Round. So stay with Cramer. I can barely believe the run in the shares of Shark Ninja, which makes Shark brand cleaning products and Ninja brand kitchen appliances, among many other things. After quietly listing its shares in the New York Stock Exchange a little over a year ago, this stock has more than doubled, including a monster 17% jump after the company reported a really impressive beat and raise last Thursday. Even better, Shark Ninja gave an excellent full-year forecast, talking about 20 to 22% sales growth when the analysts were only looking for 15%, and they detailed how this is going to happen. So we got to find out how they've been able to pull this off. Let's take a closer look with Mark Barocas. He's the CEO of Shark Ninja, to learn more about the story. Mark, welcome back to Mad Money.
Thanks so much for having me back.
Of course. Now, there's a great moment in your conference call. Most people are not as illuminating as you are in a conference call, where people are asking, why are you so good? And you say, it starts with identifying a known or unknown consumer problem and trying to solve that problem. Talk to our viewers about how you do that in some of your verticals, because it's quite exciting.
Jim, I mean, we do that in so many different ways. I mean, we're in hundreds of consumer homes every year. We're scrubbing social media. We're scrubbing online reviews. We're in restaurants and commercial environments. We're in offices watching how people clean. And we're looking for that consumer problem nugget to try to come up with some way to solve. And I think we've done that across 34 different product categories over the course of the last 16 years. And some of the really exciting products that we've done that with recently have been our Ninja Frostvault coolers, where we identified this problem of the soggy sandwich. Or we just recently did this with a new product that we launched called the Ninja Slushie, that's bringing convenience store slushies to your countertop. So we've been able to do it across big definable markets. We've been able to do it across markets that have been smaller, that we've enlarged the size of the market. But that's really the drive and the passion of the business.
All right, let's dig down to the slushie. 100,000 waitlist, which is really incredible. And I said to my wife when I showed it to her, I said, I've always said, how come I have to go to the movie theater to get this darn thing, and it's so expensive? How did you figure it out, and how did you get the people willing to comply who are involved with this?
Well, look, Jim, I think it goes back to, let's start with the Ninja Creamy that has over 1 billion views on TikTok and Instagram and has been a real success. We identified this love or excitement that consumers would have for making ice cream at home. And we're always looking at ways that the consumer is enjoying or doing something outside of the home that they're not able to do inside of the home. And the example that you just gave is the perfect one. They might go to a fast food restaurant, they might go to a mall or a convenience store, but there's something that they can't do within the home. And another great example of that is the Ninja Cafe Luxe that we just launched. I mean, being able to make espresso and coffee and cold brew and so many different coffee drinks on their countertop, again, something that they were doing outside of the home in a place like Starbucks, but now we're able to do it inside the home.
All right, Mark, let's dig down on that one, too, because the fact is I bought it yesterday at Best Buy because I wanted the espresso martini. And I'm tired of paying $1,100 for a competitor. You and I both know that's a very good machine with a lot of good stuff in the mall. How are you able to come in $500 less than a competitor that we know is a very good builder?
Well, look, one of the things that we're looking at is how do we enlarge the size of the markets that we participate in? So in the example that you just gave, the market for espresso machines in the United States is less than 1% household penetration. But it's something that consumers want to do. But they told us that, one, they're too expensive, and two, they don't give enough versatility to the consumer. So we looked at that market and we said, let's not just offer espresso. Let's offer drip coffee. Let's offer it in a 16-ounce travel mug size. Let's offer cold brew, iced coffee, cold presso. Let's not just froth the milk, but let's be able to froth non-dairy milk as well as dairy milk, or froth cold as well as hot. And when you put all of those things together, we really look at what are all the features that the consumer will be willing to pay for. And we came away with the fact that consumers, through our testing, was $499 was the right price for that product. And you might think, wow, $499 is expensive. But as you said, these products can cost over $1,000. And so with what we're offering from a versatility standpoint and a value standpoint, the product's doing great right now, as you pointed out, in Best Buy, on Amazon, and also in our direct-to-consumer sites.
All right, now you have a terrific group of engineers. I know you're still adding a large number of engineers. And so you're handling that side well. With an election coming where there are some people, some presidential candidate really doesn't like China. No one doesn't seem that fond of it either. Are you ready to be able to move the rest of your supply chain out if it turns out that you have to cost the espresso means suddenly costs $1,000 because of tariffs?
Well, regardless of who wins the election this November, we have been working for the last 5 years to diversify our supply chain outside of China. Today, we make all of our 301 tariff products outside of China. And by the end of 2025, we will be making all of our U.S. products outside of China. So again, regardless of who wins, we think we're really well positioned to avoid any of the geopolitical challenges that may exist.
And where's that? Vietnam, Malaysia? I know you're doing some in Vietnam, but I'd like to know who our friends are. Where else do we get things done in this overseas that like us?
Yeah, so it's really all through Southeast Asia. As you pointed out, Vietnam, Thailand, Malaysia, Indonesia. We're looking at Mexico. We're looking at doing some manufacturing in places like Brazil. So we've really kind of opened up the global market to figure out where is really the right place for us to get the quality that we need, the fast turn time, and the extraordinary value that we deliver to consumers.
Well, whether it be knowing how to use social media or knowing how people buy things and where they buy them or where to build them, Shark Ninja, you guys are very, very impressive, Mark. I want to thank you, Mark Barocas. He's the CEO of Shark Ninja. What a stock. Thanks for coming on. Really exciting.
Thanks so much, Jim.
All right, Mad Money's back into the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. Because everybody around from Polaroid saying the stock attended buy, so didn't know the cost. So you play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Tim in Wisconsin. Tim.
Hey, Jim, I wanted to get your opinion on Aflac right now. Is the buy, sell, and how about
it's not my fave. I do like Chubb in the insurance business, but that's really about it. Let's go to Joanne in California. Joanne.
Hi there.
Hey, Joanne.
Is this the maestro himself?
All right.
I need your help with some homework assignment I have for my TGIF, 12 Girls in Finance, little investment.
All right. I like that club. I like that club.
Anyway,
how can I help?
We're trying to diversify, and we have nothing in the healthcare sector. So I came upon, well, actually, we'd like to find a smaller mid-cap, but they're hard to find. So I came upon Elevance, ELV, Elevance Health. Just wondered your thoughts on it before I...
Sure. Okay, Elevance is the old Anthem, and people keep thinking, well, what is this brand new Elevance? It's not new, and that's why I'm suggesting, even though Anthem was okay, that United Health is still the cream of the crop. I couldn't believe how they've been able to accomplish so much during this period that nobody else has. Let's go to Matthew in Texas. Matthew.
Yes, sir. Jim, thank you very much for taking my call.
Oh, absolutely. What's up?
I have been looking for a good lithium miner for quite a while, and I've had my eye on ALB.
Yeah, it's a good lithium miner, but a business that we don't want to be in. I mean, this is just an EV. EVs are not ready yet. There aren't enough charging stations. A lot of other different issues. So we're going to steer clear of Albemarle. Let's go to Gary in Texas. Gary.
Hey, Jim. Thank you for taking my call.
You're quite welcome.
I'm 74 years old. I'm always concerned about my vision and my eye health. I follow a lot of small companies that make eye products. But one in particular I follow seems to have an outstanding management team that always delivers on its promises with consistent growth. It just had a fantastic quarterly letter and stockholder and earnings. What is your opinion, sir, of HROW, Harrow?
I don't know. Harrow. I'm going to have to come back on that one. I'm going to talk to my chief scientist and research director, Ben Stoto, and we'll come back with that. Let's go to Noah in South Carolina. Noah.
Hello, my name is Noah Jacobs. I'm a rising senior at Brigham Young University, Hawaii, and a beginner investor. After the tragic Maui wildfires last July, shares of Hawaiian Electric plummeted from $40 to around $13 and have been hovering there the past year. What are your thoughts?
Man, I'll tell you, this was a conundrum. They had some bad stuff to say today about their concern, about their ability to continue, which, of course, is not a problem. But they need a seasoned person. They need a Patty Poppy to come in there like PCG, because they really do. I honestly, I'm not sure they know how to handle this situation. I really am not sure. Let's go to Tyler in California, please. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
I am doing well. How about you?
I am doing good, thank you. With Snapchat being down 50% in the past month, is now a good buying opportunity?
No, they could use Patty Poppy too, frankly. I think that Snap is really not investable. When I listen to that conference call, I just have to tell you that they seem like an irrelevant company. I know that's a tough judgment, but that's what I'm paid to do. Let's go to Jeremy in California, please. Jeremy.
Hey, Jimmy Chill.
Yo, man, what's up?
Today? Oh, doing good, man. I bought into this company around about $40, $50 a share. I've been loving the ride the last 4 years. And recently, after the denial of CHIPS funding, I was curious, what do I do with AMAT? We got earnings looming next week.
All right, look, I think that the company's doing well. I think that the government is not crazy about their posture because they do so much business in China. Now, I think that's a shame. I mean, to criticize a company or to be skeptical of a company that, frankly, has done a great job does rankle me, but I think that AMAT's a buy, okay? Let's go to Anthony in North Carolina. Anthony.
Mr. Cramer, booyah.
Yes,
Go
booyah. Yes,
Jim,
indeed.
I got a rather large position in a monthly paying dividend stock. I want your opinion on it. The stock is Main Street Capital.
That's a business development company. I have never trusted business development companies. I don't care. I don't know what they own. I'm not going to recommend one. I've actually steered clear of them and really helped a lot of people doing so. Let's go to Jerry in Illinois. Jerry.
Hi, Jim. I need your help.
Yeah, sure. Came to the right place.
This Thursday, Alibaba reports. Do you think they can finally start turning things around and you give them a gold medal?
Okay, here's my problem with Alibaba. It is an incredibly cheap stock, all right? They're going to report a great number. And then there's always going to be something that people don't like. And then they sell it down. But I'm going to tell you it is a cheap stock. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, making sense of a sell-off. Cramer wades through last week's Manic Monday for answers. Next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
did happen when the market fell apart a week ago? Why is everything so opaque? Simple. Nobody in this business is required to talk about how they blew it, how they simply didn't know what they were doing and lost a lot of money and caused your portfolio to get hammered as collateral damage. That's how we ended up with the disaster we had last week and the ensuing comeback we had last Thursday. When you get a sell-off, you always try to figure out what's really at stake. What's gone wrong? If you go back to 1 week ago when the Japanese market fell apart, we saw most of our big cap stocks fall apart with it. We witnessed the collapse of the small cap trade. We fretted over the sudden decline in the financials. It's always interesting to watch the process of the decline unfold if you can do it clinically. It began with an examination of the bond market. We saw a dramatic decline in yields. We couldn't get a straight story, so journalists, after speaking to their sources, claimed that our economy was headed for a hard landing. Of course, that was totally false. The big buyers of treasuries were related to the Japanese meltdown, nothing more. The huge tech sell-off, we heard all about how AI had been defrocked at last and companies buying mountains of chips from NVIDIA were all marks. The rumor that NVIDIA's new high-end chips were running late became common parlance to the point where we decided that the whole companies are being set back by the product's lateness. NVIDIA became the goat of the game. That whole anti-tech thesis still lingers, but here comes NVIDIA jumping 4% today. All very positive UBS piece that said the whole Blackwell disaster turns out to be much ado about nothing. In short, there's nothing new at all here. And even if there were, the company's current iterations of high-end chips, the H200, can fill in the gap. Now, look, I fully expect the stock to get hit again tomorrow. Many of its holders know little about the company. They really, I mean, they just tell you they love it. But it was a huge buy a week and 10 points ago. The banks, we tried to blame the decline on commercial real estate woes, but that turned out to be a tough sell, given that tons of people have come back to work 5 days a week, making the Class A office buildings pretty valuable again. Yes, there are plenty of out-of-date buildings that are for sale, but it looks like the woes are manageable. Obviously, the bank stocks are still down. I think they represent real value here. The small caps are trying to come back, but there's a big issue here. It turns out that the small cap trade was really hard to unwind without pressuring the stocks because no one actually bought the stocks. They bought the ETFs and buyers inundated with stock walked away when the sellers came out of the woodwork on Tuesday. Is the trade done? The buyers will nibble. But we now know that it's easier to get out of the small caps than it is to get out. It's easy to get in and get out. And I've got to tell you, a lot of this stuff is not done. That is still unwinding. Now, let's go back to the Japan problem. We keep hearing that there was this great unwind of the yen carry trade. But that's authentic Wall Street gibberish. The reality is that a bunch of money managers took advantage of how you could borrow against Japanese bonds, which had a very low interest rate, and then have relatively free money, which you could then put to work in stocks all around the globe, including here. The managers who did this trade, and it was many different firms, didn't anticipate that the long dormant Bank of Japan would wake up and put through 2 rapid-fire rate hikes. They own a lot of stocks around the world, and they had to sell because they were playing with cheap money that suddenly became a lot more expensive. And that caused a sell-off, no more, no less. Now, if we'd known who these ill-advised managers were and how big their positions were, then that would have been the story, as opposed to all the bogus pin the tail on the sell-off headlines we got last week. Of course, that doesn't happen because secrecy is everything on Wall Street. These clients' names were protected, but if their story had been written, everyone would have had a different attitude toward last week's decline. We've had so many sell-offs based on mistaken strategies by large institutions that forced journalists and commentators to create bogus alibis explaining why the market's going down. Their tortured analysis could be avoided if we knew the identities of the ne'er-do-well funds, along with their strategies, their leverage, their destruction. We can't do that, though. We can't find out the names, but let's remember last Monday's sell-off and consider that it might have been about nothing more than flailing money managers, which is often the case with these big market meltdowns. Like I said, as always, a bull market summary. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.